Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Coming up, we'll welcome our good friend Dan Norcini back to the program and have him break down what's happening in the markets like few can. Dan explains why gold has been moving up so far this year, whether or not metals investors should be concerned that silver is lagging, and what he sees ahead for both metals in the weeks and months ahead. Don't miss a fantastic and incredibly informative interview with Dan Norcini, Trader Dan, coming up after this week's market update. Well, the rally in the gold market continues to show signs of resilience and of something bigger in the making. After getting hit in overseas trading on Monday and again on Tuesday, gold rebounded on Wednesday and Thursday, closing Thursday near break-even for the week. As of this Friday recording, gold prices come in at $1,233 per ounce, a weekly decline of just 0.5%. Turning to silver, we're still seeing the white metal lag behind gold. Silver prices currently come in at $15.43 an ounce, down 2.2% this week. We'd like to see silver, platinum, and palladium, and essentially the entire commodities complex show more technical strength to confirm gold's recent breakout to the upside. Although my podcast guest Dan Norcini will explain his take on whether or not that should be a concern for metals investors. So stay tuned for Dan's analysis on the technicals for gold and silver. Crude oil prices did experience a big rally of nearly 10% earlier this week to bring the price of a barrel of oil back up near $30. It is giving back much of those gains today, however. The oil market is still down a few percent for the year and down over 65% in the past 2 years, pushing many oil companies to the brink of bankruptcy. The precious metals mining industry also faces tremendous challenges. After 2 years of gold and silver spot prices trading near or below miners' all-in production costs, the weakest companies in the industry have been totally wiped out. Even the strongest mining companies are struggling with losses. This week, Newmont Mining released quarterly earnings and reported an operating loss for the fourth quarter of 2015, with revenue down more than 10%. Newmont's earnings slump was worse than analysts had expected. Shares of the gold major initially fell on the news in the after hours Wednesday, but by Thursday's close, Newmont's stock finished in positive territory. Resilience to bad news is one of the hallmarks of a bull market. And as bad as the news has been and continues to be for the mining sector, gold stocks have actually been on fire over the past month. Since January 19th, the Huey Gold Stock Index has shot up more than 50%. Clearly, some investors are betting big that gold prices have finally bottomed and the worst problems in the mining sector are behind us. Gold could continue to benefit in the months ahead from a diminished economic outlook. On Thursday, the OECD revised its projections for global economic growth in 2016 and 2017 downward. The globalist body acknowledged that loose monetary policies around the world have been largely ineffectual in terms of stimulating actual economic activity. But that doesn't mean central bankers won't keep trying to roll out new stimulus schemes. Here in the U.S., St. Louis Federal Reserve President James Bullard said that additional rate hikes would be, quote, unwise. This dovish posturing comes on the heels of the latest FOMC meeting minutes, which show the clowns at the Fed are now concerned the economy's performance could worsen in the near term. Cynics might wonder whether Fed officials are just taking their cues from the stock market, which recently slapped their rosy economic outlook in the face. The Fed has pumped trillions of digital dollars into the financial system since it announced quantitative easing. Banks, hedge funds, and high-frequency trading algorithms have flourished. Financial proliferation made possible by the Fed's churning out of unbacked fiat dollars from its electronic printing press. The danger is that it's another massive financial bubble that could be on the verge of bursting. But leave it to government officials and establishment economists to ignore the massive systemic dangers of the digitized financial sector and instead worry about people who carry $100 bills in their wallets. Former Treasury Secretary Larry Summers penned a column in the Washington Post on Tuesday titled, "It's Time to Kill the $100 Bill." Yes, the man who is in the running to replace Ben Bernanke as Federal Reserve Chairman and control trillions of digital dollars at his fingertips wants to abolish $100 bills in order to make it harder for you to engage in large cash transactions. It's a step toward a completely cashless economy, something that won't work, by the way, according to my podcast guest Mark Faber last week. But nonetheless, attempts at a total physical cash ban would enable the government to digitally record and track every dollar-based transaction. It's Big Brother's dream, but his grand plan for an all-electronic economy would backfire if people would move out of the dollar and into underground alternative currencies or barter instruments. Gold and silver coins could reassert themselves as a common currency in transactions. Regardless of what plans policymakers have in store for the dollar, the intrinsic value of a gold or silver coin will always be widely recognized. Well, now, for more on the rally we've seen in the metals so far this year and how long it's likely to last, let's get right to this week's exclusive interview. It is my privilege now to welcome in Dan Norcini. Dan is a professional off-the-floor commodities trader bringing more than 20 years of experience in the markets. Dan's editorial contributions and supporting technical analysis charts cover a broad range of tradable entities, including the precious metals and foreign exchange markets, as well as the broader commodity world. He is a frequent contributor to both Reuters and Dow Jones as a market analyst and can be found as a source in the Wall Street Journal's commodities section from time to time, as well as CBS's Market Watch. You can follow his fabulously detailed work at traderdan.com. Dan, welcome back. It's been quite a while, but it's great to have you on with us again. How are you?
I'm well, Mike. It's a pleasure to be back. It has been a while. It's always good to talk to you. It'll be a fun interview. There's a lot going on.
Yeah, to start out here, I want to get your thoughts on the market action so far this year. We're seeing a good start to 2016 for the precious metals. As you just mentioned, they appear to be diverging from the broader stock market. Assess the year to this point for us, if you would. What's your take on the way the metals have been acting in the face of some real turmoil in other markets?
Well, I think, Mike, we finally look like we've got some rising fear and uncertainty or confusion or a lot less conviction that we had about the overall health of the global economy than we had for so much of last year. You know, we had underneath the markets, there was sort of this given that the central banks were going to be there. They were going to, be providing liquidity. That liquidity tends to mask a lot of the problems that were, structural problems that are deep-seated in so many of these national economies, whether it's here in the U.S., whether it's overseas in the Eurozone or in Japan or even China for that matter. And as long as that central bank, let's call it the old punch bowl, as long as that was there, a lot of these problems, they were sort of just glossed over. Traders were looking at this huge amount of money being created through quantitative easing. And then, of course, you had the ECB with their program last year. I guess they started that up in March, if I remember right. And, the Bank Japan never ended theirs. And you've got all the stimulus that was being provided. And it seemed like what sort of got the ball rolling to the downside, at least started to put some uncertainty in the traders' minds, was when this first rate hike, and the Fed had been telegraphing here in the U.S. for, I guess since the last quarter of last year, I should say, 2015, that there was going to be the expectation of a rate hike. And that started getting people a little bit nervous in the markets, particularly when you had the Chinese yuan devaluation that we all witnessed in August of last year. Of course, that knocked the markets for a loop. They stabilized and they came back. But it seems to me like ever since the Fed did that 0.25% rate hike in December, it seems like a lot of the air has been let out of these markets. And, of course, you just have lost that liquidity support that was propping so many of these things up. And once these markets started to totter, then you saw this uncertainty and this fear and confusion start to arise. And now we're at the point where nobody really knows what's going on, but nervousness is increasing. And as this nervousness has increased, this uncertainty, you've started to see that reflected in the moves in these markets. You see it obviously in these global equity markets, which have been swooning. Of course, you see it now in the currency markets, as the currency markets they have no idea what to do in the currency markets. I mean, they're up one day, one currency's leading the pack one day, the next day it's down, the third day it's back up. I mean, markets are flipping, flopping, flipping back and forth. Again, no conviction, a lot of uncertainty, a lot of confusion. And that, in my mind, that's one of the reasons that we really started to see a firm bid go into the gold market this year. And, for the first time in quite a while, 3.5, 4 years, we've really seen some strong signs on that technical price chart. From a technical analysis perspective, that chart has really perked up. And you've got some good signs in there now. And, of course, what you're seeing, I believe, in the metals is simply the fact that you've got to the point now where traders are really worried about the longevity of these central bank stimulus efforts to actually create something in terms of lasting prosperity. In other words, it's almost like we're reaching a point of diminishing returns, Mike, where traders, investors seem to be losing confidence in the ability of the central banks to actually fix what ails this global economy. And I think that's what you're starting to see now. You're seeing that reflected in the currency markets, and of course that's spilled into gold. You've seen it reflected in the interest rate markets. Now, we've got negative interest rates not only in the Eurozone, we have them in Japan. There's been chatter about them coming here in the U.S., although some of the Fed governors have knocked that idea down right away. But, the fact that you're even seeing that floated over here just goes to show you how much uncertainty is in the markets now. And how weak this global economy is. And, of course, in that environment with all that confusion, people just don't really know where to go. They're kind of concerned what to do with capital. They're afraid to put capital in equity markets because that central bank support's not there, or at least it's not working like it used to. They don't really want to lock up money long-term in bonds, particularly bonds that are paying next to nothing for long-term bonds. And so you're seeing that money starting to move into gold in a big way. And, of course, that's been reflected in the rise in the holdings in the gold ETF, GLD. We've had a really healthy increase in there. And to me, that's a very good sign for this market as far as gold goes, to see that kind of interest that's finally materialized over here in the West. We've talked about this, Mike, I think in the past, where that GLD to me is a proxy for Western-oriented investment demand in the metal. And when it was falling, when those reported holdings kept declining, you could just tell that big money managers here in the West, institutional outfits, just did not have a lot of interest in owning the metal. And, of course, as they didn't, the price, money flowed out of the gold sector and moved into other areas, other asset classes, and you saw it reflected in a declining gold price. But now you're seeing that interest reviving over here in the West, based on those rising GLD holdings. And, of course, you're seeing that reflected in the improvement in the price chart. So, we've got some good support in this market right now for gold. And honestly, it's been the best performing market on the planet right now for the first 6 weeks of this new year.
Yeah, gold seems to finally be acting like a safe haven in the face of all that turmoil, the safe haven that it was once thought to be. So as the tide finally turned, because I remember you saying all of last year that until investors stop favoring U.S. government bonds as their preferred flight to safety, that it's going to be tough for gold to break out of its 4+ year long downtrend. So are you starting to see that trend reverse, and has that cycle maybe finally been broken?
Yeah, it looks like it has for now, Mike. It's been interesting watching the change in sentiment in regards to gold and in the interest rate markets. As you mentioned, I'm just a big proponent of watching, particularly the bond markets, and not only here in the U.S., but, the German bond market, and the Japanese government bond market as well. And you're right. That's what we were seeing for the longest time. We would see during a so-called safe haven rush, when traders or investors were concerned about safety of invested capital and in equities, for most of last year, well, let's just put it this way, for the majority of the last 3.5 years, they didn't seem to be interested in moving into gold. They preferred the safety, in their mind at least, the safety of government bonds. And again, until something shifted, with regards to sentiment, you weren't going to get much of a bid in gold. But it seems to me like you had something happen in these bond markets, and I can't put my finger exactly on what the cause was, because in one sense, the underlying fundamentals were always there. We still had the same issue about the lack of overall economic growth. We still had the fears of deflation. Toward the end of last year, we had concerns about China. You had concerns about the health of the Eurozone. All the stuff that was going on over there. We had every now and then we get a lousy unemployment report over here in the U.S. We weren't seeing a lot of growth. But at the same token, you didn't see money going into gold. You just saw it going in the interest in the bond markets whenever there was any sort of sell-off in the global equity markets or people got nervous. And something happened. Something shifted that perception, really particularly to start off this year. And like I say, I think it went back to when the Fed hiked that 25 basis points. When you think about it, 0.25% is insignificant from an actual standpoint when you're talking about, it's the first interest rate hike in years. And yet it did something to the psyche in the markets for some reason. Then again, that was, compounded by the lack of growth, the lack of improvement in the Eurozone and those continued push of the interest rates into negative territory. And it seemed like at some point investors said, you know what? There's zero opportunity cost in holding gold right now. There isn't any. So let's get it because of this instability we're seeing in the currency markets. We see instability in the global equity markets. It's not costing us anything to own the metal. Heck, why not? We may even get some capital gains out of this. And something shifted, and that sentiment shifted with it. And man, you just see it. You see it improved in the gold chart, and you saw the metal move up. And right now, just looking at this thing, Mike, it doesn't look like there's anything that I can see on the immediate horizon that's going to shift this. So to me, it looks like gold should remain relatively well supported here. And actually, the price action in the last few days confirms that. You get a couple of days of rally in the equity markets. These risk trades come back on. Stock markets pop higher. All of a sudden, everybody's go, this is the all clear signal. Everything's going to be fine. The central bank's going to fix everything. And then the rally peters out, and it's dashed by some actual hard economic news. And bingo, you see the risk trades, they reverse. The risk aversion trades come on. You see the yen rally as the yen carry trade unwinds. You see the bond markets move higher, pushing interest rates even lower. And then up goes gold, just like it did today. And that seems to be the pattern that we're watching right now. And, until we see something shift again, Mike, it's hard to see this gold market breaking down right now.
Now, in terms of the rally and the metals that we've had, is the fact that gold and not silver is leading the way this year a good thing, or is it evidence that maybe the rally hasn't been confirmed yet? As we're talking here Thursday afternoon, we've got gold up 16% this year, while silver is only up 12%. The mining stocks are doing well too, but should the bulls be maybe a little bit nervous that the white metal isn't leading?
For me, not really. That's my view. Obviously, you'll get different views from talking to different folks. But the reason I say that, Mike, is a couple of things that I like to watch. This is a personal view of mine. I happen to believe that silver is going to outperform gold when you have an inflationary bias in the marketplace. In other words, if you've got a situation where investors are looking at whether it's as a result of currency debasement, whether it's just a result of accelerated growth because of ultra low interest rates and the economy potentially overheating, wages going up, home prices rising, et cetera. In that sort of environment, I would always look to see silver doing better than gold. However, when you flip it around, when you've got an environment like we currently have, where you have slow growth fears, where you have a sluggish growth environment. For instance, you look at the copper price, you look at the price of platinum, you look at the price of palladium, you look at those other industrial metals, and you and I know that platinum is sort of a quasi-industrial precious metal, sort of functions both ways, much like silver does. Silver sometimes doesn't know what it wants to do, whether it wants to be an industrial metal one day or a precious metal on the other day, and sometimes you'll see it following the industrial metals lower, like copper and platinum. Sometimes you'll see it following gold higher. But the one thing I've noticed that's been pretty consistent of late is that whenever you see a general weakness in the industrial metals, and you've got gold popping higher on a safe haven bid, silver tends to lag simply because the rest of the industrial metals are lagging in that slow growth environment. You think about it this way, Mike. The story for the longest time when it came to the industrial metals was China. Everybody talked China. China's buying up the world's copper. They're building everything over there. And you got, China's buying up platinum. China's buying up palladium. Everybody was talking about China buying nickel and molybdenum and everything else you could think of. Well, when that was going on, silver was just really rip-roaring to the upside because it was kind of lumped in with that, and everybody was talking about the Chinese story. But when China started to slow down, and you started to see supply concerns arise around these industrial metals based on the current level of demand, that's when silver seemed to get sluggish as well. As far as I can see, this is how I look at it, as long as you see platinum prices generally weak and copper prices generally weak, I think you'll see silver lagging gold. But I don't think it's necessarily a harbinger of a move lower in the gold price, simply because gold is really functioning more, let's call it a slow growth, deflationary, ultra-low interest rate environment. It's doing exactly what it's supposed to do. It's serving as a store of value, and it's actually holding up very, very well. And obviously we've seen it make some nice gains this year as well. I think for silver to do that sort of thing, you'd have to see it detach itself from the slow growth environment scenario that surrounds copper and platinum, and have to see it focus almost exclusively, like shifting out of its industrial metal viewpoint and moving more toward its precious metal viewpoint. Now, could that happen? Sure. But I think you'd have to see something that would trigger a shift in the sentiment, and right now I don't see that. But for me personally, I don't see it as a cautionary note when it comes to gold. What I actually am watching more so for a cautionary note on gold, assuming that there would be one, which I don't currently see, would be a sharp sell-off in the mining stocks, which we're not getting. The mining stocks are doing very, very well. Or a sharp drop in those reported holdings in GLD, and quite the contrary, we're not getting that. Those holdings have been increasing. We had, since the start of the year, they're up about 73 tons at one point. We saw them drop about 5 tons the other day, but that's relatively insignificant. And heck, for after this afternoon or tomorrow, we may see them go back up again for all I know. But as long as those other factors that I'm watching, namely the gold stocks and the GLD holdings are firm, I wouldn't be worried about what silver is doing as far as it impacting gold.
One would think that the possibility of negative interest rates here in the U.S., you touched on it earlier, and then also negative interest rates globally, of course, that would be very bullish for gold. Talk about that for a minute, because obviously the criticism made by many about gold has always been the carrying costs involved. But with a negative interest rate environment, you'd have to think that would be incredibly beneficial for demand of the yellow metal and ultimately prices as well. Is that fair to say, Dan?
Yeah, I think it is, Mike. I think you said it as good as anybody else could say it. I mean, there's literally no opportunity cost to hold it. I mean, you're putting money in, in bonds that are paying next to nothing. And obviously there's some people who are content to lock up money for 10 years at, 1.7% in a 10-year treasury. I guess if you compare it to a 10-year German bond or a 10-year Japanese government bond, well, it looks like you hit the jackpot when you buy a U.S. 10-year treasury. But for most investors that have a sort of a longer term horizon, personally, I wouldn't want to lock up money in a government bond for 10 years at 1.7%. So, you do see money moving into gold for that reason. And again, there's just not much opportunity cost in holding the metal, and you do have the chance for upside appreciation, particularly when you're in an environment that's as uncertain and as chaotic as it is right now, Mike. It'd be one thing if we had this ultra low interest rate environment, but stocks were moving steadily higher, and wages were kind of maybe gradually moving higher. In other words, you had this scenario that we had for the longest time where interest rates were low, but stocks were making, it seemed like almost every other day you'd see the S&P made all-time lifetime high, or the Dow is flirting with a lifetime high, or the Russell 2000 making a lifetime high, and the Nikkei is moving strong, and the Chinese markets are all doing well. Well, that's one thing if you've got low interest rates. Okay, in an environment like that, people are saying, you know what, there's not much opportunity cost in holding gold, but there's not much upside in capital gain appreciation potential either. So why would I bother holding it? I'll just put the money in the stock market. But now that you've got that other factor removed, now that these stock markets are so shaky, again, there's no reason really not to own gold in this environment, and that's why you're seeing these holdings rise, and I think that's why you're seeing the mining stocks go up as well.
Well, as we begin to start to wrap things up here, give us an idea what you're looking for on the charts for gold and silver. As a trader, what are you looking for there? Support levels, resistance, and so forth.
Okay, well, with gold, and I made note of this on my website this week. We were watching that big sell-off. I think it was Monday night or Sunday night. I'm trying to remember what night it was. All of a sudden it seemed like, you got a rally in the stock markets. The oil price stabilized. Of course, we had a big, sharp sell-off in gold. But it ran down, Mike, interesting thing on the chart. It ran down to a really key technical support level right around the 1190 level. And I noted on some of my comments about that was a 38.2% Fibonacci retracement number off from the rally off the high up there around 1265, whatever it was. And that was a key level, and it held it. It bounced off of that, ricocheted off of it, as a matter of fact, and then it popped up the next day, and then, of course, it moved up again some more today. So the support level that I'm watching on the downside is 1190. Now, if you think about it, I mean, gold basically went from around 1070, $1,070 an ounce, all the way up to just shy of 1270. So, we're talking about a $200 an ounce rally in about a month. That's a pretty torrid rally, pretty impressive. And if you look at the ascent, the slope of that ascent line, man, that thing is really, really sharp, Mike. It's very, very, very steep. Generally speaking, as a general rule, markets that climb that steeply, they can't sustain that rate of increase. It's just so steep. It's so quick. Now, of course, if you have something catastrophic happen, sure, it could do that. But generally speaking, once the market reacts, to the initial fear, the concern, and you get that sharp acceleration, you get a lot of shorts that were in that market get squeezed out. The new longs that are coming in are pushing them out as well. Anytime you get sort of a let up in the fear factor, in other words, things calm down just a little bit, doesn't mean the problem's going away, but the intensity of the emotion that drove it up in the first place subsides somewhat. That rate of increase in price is just too steep to maintain, so you get a setback, and that's what we've seen. And then as traders and investors, we watch the charts to see where that price will stabilize as far as support. Well, right now it looks like 1190 has been really solid support on the downside. And I actually think that it would be healthy for this market for it to sort of bounce around here now and just work off some of the overbought status that it has and sort of consolidate in this area, maybe between, let's call it 1240 or so on the top, 1190 on the bottom. It's about a $50 range. But if it would work back and forth within there, consolidate, I think that would provide it a good base for another leg higher in the event another domino or a shoe were to fall from somewhere, around the globe, some sort of unexpected event or some further negative news or something else that we got. You would have a pretty powerful base from there to bounce up higher. Markets that shoot up too quickly tend to burn themselves out, Mike, and then they don't sustain those gains. And I think, most of the people who are, wanting to be friendly toward gold, they don't want to see the thing shoot up and then like a meteor and just flame out and come right back down again. So a pause in a uptrend of that steepness is a good thing, actually. So going back to your original question, 1240 or so is our resistance level. Above that would be 1265 to 1270. Looking at the chart, if gold were able to close through 1273 or 1275, I think you got a very good chance of this thing making it to 1300. You have that much momentum in this market. If you look at the weekly chart, I mean, it's broken out considerably, and particularly the fact that it's been able to stay above 1200 is constructive. So, you got some good upside momentum in the market. Like I said, if you take out a key resistance level overhead around 1273, 1275, then you got a shot at 1300. My goodness, if this thing were able to go through 1300 for any reason, then you're talking 1375 to 1400 then becomes realistic, because something obviously would have changed in the current global investing environment that would bring about that kind of buying. Something would have to have happened that would be rather dramatic. And at that point, you would start to see some real momentum trades coming in here. You know what? A lot of what we had is short covering in this market, Mike. We've got some new hedge fund long side interest in it as well. But we don't have a overwhelming majority of those guys really piling in heavily on the long side yet. And we've all seen what can happen in the past when that group does commit to a market on the long side. So, as I mentioned, if you got some sort of event, and who knows, I mean, we're in such a chaotic environment right now, such a time of uncertainty. If anything were to happen that would upset this so-called equilibrium that we've had the last couple of days or so, it would not take much to push this market higher if those funds decide to come piling in on the long side again. So that remains a possibility. But again, the market would have to prove itself technically. It would have to take out 1300. And again, as long as the HUI stays supported, it's hard to see gold breaking down. And right now the HUI looks pretty good on there. I mean, it's very strong on its chart. As long as the HUI is rising, it's going to discourage aggressive selling in the gold bid, I can tell you that.
And how about silver? We haven't necessarily broke out of the range that's been going back for months now, whereas gold maybe has. What are you looking at for silver on the charts?
Yeah, silver's improved, Mike. It definitely has. I mean, you can certainly say you've got a really solid bottom down there above 1350. That's called, in that congestion zone, which was really between either side of $14, Mike. You had sort of a congestion zone that was in effect probably, really going back to November, 3 months, 3.5 months now, and you broke out of that. So you got a good base on there. And as I mentioned when we started this talk off, if it wasn't for the weakness that you were seeing in the industrial metals, particularly in copper and some of the other markets like platinum or palladium, you'd probably see silver even higher. But again, it's got a little bit of a lead weight tied to it in that regard. However, like I said, on the chart, it has broken above that congestion zone, and the fact that it was able to clear 1450. And not sell off right away, well, that was constructive because what happened at that point, you had some shorts decide they were going to cover it, that the downside didn't look like it was going to be readily apparent, so they decided to get out of Dodge, and when they did, you had some new longs coming in that market as well. So you did get some momentum guys in there, and they were able to chase it up through 15, which was, in my mind, a big accomplishment. Now, the key in looking at silver is the fact, I'm looking at roughly that $16 level. You made a run up to 16, a little bit over that, 16 and a quarter or so back in October of last year. And then the market just promptly fell apart. I mean, we went from about 16 and a quarter all the way down to about 13 and a half in about, 2 months' time. That was a pretty brutal downdraft. But you're back up there knocking in that general vicinity. You're not there yet. But if silver was able to push through 16, let's call it 1625, you got something going then, because on the chart you've got a breakout, and then that gives you some upside momentum. Then you've got the potential move at least 17, even 17 and a quarter, 17.75. It wouldn't be much to put another $1 an ounce on silver once it got through that level up there. So we'll see how it acts here, Mike, as we move further into February and see what goes on. But one thing I might add to this: if these central banks come out and they manage to concoct some sort of concerted effort where you see some additional bond purchases from the ECB, like let's say they increase their current level of quantitative easing. Let's say the Bank of Japan gets a little more aggressive in their quantitative easing. I personally don't think it's going to have much impact overall on the real economy, but as far as the trading world and the investing world, a lot of traders will look at that and go, yippee, let the good times roll, and they'll come back in and they'll push some of these commodities higher again because the risk trades will come on. You'll see the yen carry trade revived. You'll see more aggressive buying of stocks, buying of commodities in particular. Then the question is, how long does that last? I don't know. But my concern is then that the fear I have is what happens on the day where we get an announcement by the central banks that we're going to get an increase in quantitative easing. The market initially responds positively for 1, 2, 3 days, maybe even a week, and all of a sudden, selling starts coming in. I tell you what, if we see that sort of thing happen, and I'm not one giving the dire predictions, I'm not one of these guys, gloom and doom thing, but I'll tell you what, if you see a big, massive effort by the central banks to reflate further by increasing quantitative easing or some sort of other stimulus measures, and you see the market initially respond positively to it and then abruptly sell off, we're in trouble, Mike. Because at that point, what do they have left to do?
Yeah, there certainly seems to be a diminishing return effect that's happening. It takes more and more stimulus to have the same effect that they used to get here a while ago. It's like the junkie that's the fix has to get bigger and bigger in order to sustain it and still give you that effect.
Yeah, well, they keep pushing it. They've kicked the can down the road for so long. This has been my pet peeve, and maybe it's a little off topic for your listeners here, but when you try to paper over the problems in the economy by basically using monetary stimulus, and you don't really work on what I would call the structural reforms, the deep-seated structural issues that have given rise to these problems, tax codes that are oppressive or punitive, or regulatory regimes or regulatory burdens that are crushing businesses, and a lot of those things, excessive debt levels, all those sorts of things that defy a quick fix. They're not quick fixes; they take time, and a lot of them, let's face it, are politically not very popular. I mean, because they cause a little discomfort at times, and politicians basically are saying, give us an easy fix. Give us something that's not going to cause the voters to turn against us, and the central banks will step forward with their monetary measures, but that doesn't really get at the underlying structural problem that produced the slowdown in the first place, the excesses, the imbalances, et cetera. And in one sense, all you're doing with this monetary stimulus, you just keep kicking this can down the road and sort of putting a Band-Aid on it. In the meantime, the problem just festers. That's why I get concerned. At some point, if these central banks do some sort of stimulus and it doesn't work, man, oh man, then you have to really say, okay, now what? Now we're going to let the system purge itself like it should have in the first place. I don't know. We really are in uncharted territory, Mike, in monetary history. I don't think we've ever had a time in global monetary history that I'm aware of where every major global economy, whether it's here in the U.S., whether it's Latin America, whether it's the Eurozone, whether it's Asia, where every single one of them has slowed down at the same time. We've always had one region around the globe where there was some strength. This is really one of those situations where we're all going to have a learning experience in this. We're all going to learn something, and what we're all trying to do at this point is just try to protect ourselves and trying to foresee what's going to happen and trying to take some sort of steps where we don't get caught up in it if the event just does not end well. So that's my general concern. That's why, and people who listen to me, have listened to my interviews or read my website know, I've been a bear on gold for quite a while because the charts told me to be bearish, but I've always owned the physical metal, even when it was bearish. I just didn't trade it from the long side. The reason I owned it was because you always have to have some of that, particularly when there's always currency unrest. But boy, I tell you what, seeing what's out there right now, I feel very, very comfortable owning physical gold. I can tell you that. That's your insurance policy. You got to own some. You're nuts if you don't right now.
Well, despite the chaotic nature of all these markets, I always appreciate your insights and your way of explaining them. It's always very informative, and love talking to you. And seems to be a lot happening this year, and look forward to catching up with you again as it starts to unfold. And hope you have a great and restful weekend. I know you enjoy those weekends, and hope you have a good one, Dan.
You bet, Mike. My pleasure talking to you as well. It's certainly going to be an interesting year, that's for sure. What was it, the Chinese proverb, when you live in interesting times? Well, we are there. We're in interesting times, my friend. So, yeah, great talking to you, Mike. I look forward to chatting with you some more in the not-too-distant future as well.
Absolutely. Well, that will do it for this week. Thanks again to Dan Norcini. If you want to follow the fabulous market commentary and technical information that Dan puts out, just go to traderdan.com. And check back next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.